Designing procedures to audit specific account balances. So here we're now getting to almost the culmination of all what we've been through so far. If I then give you, for example, a property, plant and equipment account balance, are you able to go and take what we've done and design appropriate substantive tests to get evidence about property, plant and equipment? Can you do that for inventory? Can you do that for goodwill? Can you do that for accounts receivable? The bottom line that we need to now go and analyze in terms of answering that question is, as a starting point, what is the account balance we're looking at? Is it a balance sheet account or is it an income statement account? The relevance there is that if it is an income statement account, then clearly the assertions that are relevant are not the year-end balance ones. They're only the transaction event ones. If, on the other hand, it's a balance sheet account, then both the transaction and event assertions as well as the year-end assertions become relevant. Having made that decision, bearing in mind that transaction and event assertions are applicable to both balance sheet and income statement accounts, what you then need to do is go and identify the key transactions that are being posted into that account during the year. So for example, if you're going and testing the sales account balance and you've got a generic question that looks at sales as a whole, well, that's an income statement account balance. So we're not concerned about the year-end assertions, transaction event assertions only. The next question must be what transactions and events go through the sales account balance to then go and figure out what we have to therefore go and prove. In a nutshell, you've got two core transactions that go through sales. The sale, which is a credit into the sales account balance, and returns, credit notes that you're issuing, which is a debit into the sales account balance. Those are the two core transactions. So if you're having to design substantive procedures to test sales, you would in principle need evidence to address the 5 transaction and event assertions for both the sale transactions and the credit note transactions. Okay, so in a nutshell, what you have to do then, how do you know that all sales that should have been recorded have been recorded? Completeness. How do you know that the sales that have been recorded should have been recorded? In other words, they occurred. How do you know that the sales that were recorded are accurately recorded at the correct amounts? How do you know that they are actually sales that are sitting there in the credit of the sales account balance? In other words, they're correctly classified. And lastly, how do you know that cutoff has been correctly dealt with in terms of the processing of those sales transactions? You would then apply the same logic to your returns, to your credit notes that you're passing. So there you go and say, how do you know that all debits to sales account have been processed, that we haven't left out any credit notes? Occurrence, how do you know that the ones that you have debited to sales actually took place? Accuracy, that they recorded at the correct amount. Classification, that they belong there. And cutoff, that there haven't been processing issues in terms of the processing of credit notes to sales, early or late cutoff errors. Okay, and the nice thing about analyzing it that way is you then have a hell of a lot of legs, if you like, to hang ideas onto. It becomes much easier to go and design sales tests if you've got 10 assertions that you're having to prove. 5 for the sales transactions and 5 for the credit note transactions. Okay, you then use that to then create the framework around the assertions. Now, what I've done to assist you here is I've put together a couple of mind maps where I've taken those principles and put together frameworks for some of these key account balances. I've tended to concentrate on the balance sheet accounts, mainly because those are the ones that typically come up in the questions. But just be a little bit careful. Don't ignore income statement accounts. They are just as relevant. So what I've got here is 5 frameworks that I'm going to take you briefly through. I'm not going to spend a lot of time on here. They obviously are all on the DVD. You can print them off and go through them in more detail. But I more want to use them to show you the principle around how you design substantive procedures in terms of picking up these frameworks. Okay, so let's go and have a look at these mind maps. The first one we're going to have a look at is property, plant and equipment. I'm going to run through these various different legs. If you have printed this thing out, it's probably useful at this stage to then follow it. If you haven't printed it out, maybe you want to go into the DVD and go and print off these mind maps before you then continue with the presentation. It would obviously make it a little bit more relevant. So, from an approach perspective, the transactions that get put through the property, plant and equipment account are additions and disposals, the debits and the credits into that account. And obviously it is a year-end balance. So in terms of going and hooking up what assertions do we need to hang on to this, we're going to have to address additions, we're going to have to address disposals, the 2 categories of transactions and events. And up here, we're going to also have to address the year-end balance.